You see the results: consistent profits, clean charts, perfect trades. It's tempting to think, why build my own F&O model when I can just copy theirs? But here's the truth: trading models are built for a specific road, in a specific weather, with a driver who knows every turn. Welcome to Financial Flywheel, where we encourage and support your design to nurture and run your own financial flywheel that can take you towards financial freedom. Okay, now you copy the model without the context, and what happens? The market climate shifts, you are headed straight into trouble. Let me show you why copying someone else's strategy can go from smooth sailing uh, to a sadly total wipeout. The topic of our discussion comes under the purview of risk and psychology. Copying someone else's F&O model isn't just a technical risk, it's a psychological trap. It's driven by fear of missing out, overconfidence in someone else's past success, and the false sense of comfort of avoiding hard work. True mastery in trading psychology means resistant to that shortcut. Being resistant to that shortcut will build conviction in your own system, and you will have the mental agility to adapt when the market changes. Every F&O model has three critical parts: the underlying, which is any asset. It could be an index, it could be a commodity, it could be a particular stock. The probability distribution, that's your map and understanding of the terrain. uh, we should optimize for a positive case scenarios in 1 sigma, and optimize in case risk were to occur beyond 2 sigma. And if it is a tail event, we should definitely have hedges so that we are not booking any loss that can really burn out your account. So this is something that any designer would take care. But as a copier, it is possible that we may not even be cognizant that the designer has considered these aspects as and when the market is moving in a particular direction. The model itself is your vehicle. The creator designed their car for a road and their weather. Put it on a different road, and suddenly the smooth ride can turn into a skid. For example, if the underlying is replaced or instead of one index, we replace it with another index, or let us say we try and introduce a commodity as an underlying. So these are the variables that the creator knows what is best for the model that he or she has designed. In markets, the weather can change very fast. One day it's calm, the next a VIX volatility storm can come. The road, our underlying, behaves differently under these circumstances. The map, the probability model, is no longer accurate, and the car, the trading strategy, may have the grip to survive only if certain steps are taken. If you don't build a car with these considerations, you will not know how to adapt when a time comes. Now, here's the killer. Many of these models these days are run as bots. So, when dozens or hundreds of traders run the same bot, the market sees the same orders at the same time. So, the prices move before you can even get it filled. Slippages will eat into the profit, and the advantageous edges will disappear. The more people use it, the weaker the model becomes. When the same bot drives dozens of traders, they pile into the same strike price. But the buys will get pricier, the sells will get cheaper, and the edge bleeds out before you even know the edge is gone. Okay, let's discuss with a real life scenario. Let us assume we want to discuss an iron condor using weekly contracts. The model, which is essentially a weekly expiring iron condor with a Nifty index as the underlying. So the designer, basing on his own analysis and the current market price, has decided to sell one contract of 18,200 strike price call option and a 17,800 strike price put option. The intention of the author is very clear. He wants to optimize for a premium decay. He also puts in some protective wings or hedges that belong to the same expiry, 18,300 call option and a 17,700 put option. The goal is to collect weekly premium in a low volatile environment. It works beautifully for weeks. Low realized volatility prevents decay steadily. The creator will adjust the strike based on volatility, sometimes open interest, and even uh, environmental risk. Wherein, let us say there is a sudden announcement of geopolitical news, or there is expected economic data release, the author knows how to adjust. So in this particular case, if you notice, at first the Iron Condor was quite money-making machine, steady decay, low drama. But as word spread, the strike became crowded, premiums thinned, the edge dulled. Then, without warning, there was an economic data that was announced, and the market cracked on the RBI shock. Puts exploded in value, margin spiked, panic gripped the blind followers. The creator pivoted instantly, rolling and hedging to safety. The copiers, they stayed frozen and watched their week's plan turn into a month's loss. Well, a month's loss is still okay, but imagine if it were to go to several months. Then the recovery period for these copiers will be even more intense, and there is another psychological imbalance that will be created, which is called revenge trading, which is a flaw that we will discuss at some other point in time. So, what is the moral of the story? In F&O, when a model is overcrowded, the edge gets diluted for everyone. And when a crisis hits, only the creator knows the playbook. Copiers are left holding a position they don't understand, and the market is merciless to hesitation. Copying, copying an F&O model feels safe until we realize that we are always a step late. You take the trade but miss the creator's timing, context, hidden risk controls. When market shifts, the designer of the model adapts, but you are left exposed. And worse, overcrowded strikes makes your buys expensive and your sells cheaper. And this will result in a catastrophe as the days go by. Copying and pasting trade blinds you to context, timing, and risk, turning someone else's edge into our loss. In the end, what made them money can be exactly what drains yours. Thank you for your time and good luck with all that you're doing. Until we meet next, bye for now.